Equity Market Update, June 2021. Indian equities moved within a range during the month and Nifty 50 ended approximately 1% up compared to the last month. Equity movement were guided by recovery in growth, receding of second wave in India, strong Q4 FY21 results, elevated commodity prices, etc. This was partially offset by higher than expected inflation print in US, intermittent concerns over premature tapering of bond purchases by US Fed, rise in oil prices, etc. Mid-caps and small caps outperformed the large caps during the month. Sectoral performance was mixed as information technology, healthcare, consumer staples, and capital goods delivered positive returns, while banking, power, and oil and gas ended the month in negative. Global equities performance was mixed, with most major indices in US and Europe ending the month in positive, while in Asian markets like Japan, China, Hong Kong, etc., delivering a negative return. FPI's bought net equity worth $2.4 billion in June 2021 as compared net seller of $0.4 billion a month ago. On a cumulative basis, FPIs have bought net equity of $0.6 billion in Q1 FY22 vis-a-vis $3.9 billion in Q1 FY21. Domestic equity-oriented mutual funds registered net inflows of INR 11,845 crores in May 2021, compared with net inflows of INR 4,221 crores a month ago. In the first 2 months of FY22, domestic mutual funds have recorded net inflows of over INR 16,000 crores, compared to net inflows of approximately INR 9,000 crores last year. In general, the corporate profitability in Q4 FY21 was strong, aided by good demand recovery, rise in realization, cost rationalization, etc. Specifically, lower provisioning in banks, improvement in execution in infrastructure, higher spreads in metals, etc. supported earnings. Q4 FY21 results of sectors like auto, banks, chemicals, and metals were better than expected, whereas of utilities, NBFCs, infrastructure, and capital goods were largely in line with expectations. Results of consumer staples, consumer durables, and pharma sectors were relatively below expectations. Market rally becomes broad-based in CY21. Nifty 50 in the last 12 months or so has seen significant rally after bottoming out in March. While from the low base, the rally seems sharp, one should view it in the context that Nifty 50 returns in the last 10 and 15 years are largely in line with nominal GDP growth during that period. Another important aspect to be noted is that movement in Nifty 50 has been relatively concentrated during CY18 to CY20, with top 5 stocks accounting for bulk of the returns. However, the rally became broad-based in CY21, with share of top 5 stocks in returns dropping in H1 CY21. Further, the broader market also outperformed Nifty 50 in CY21, supported by outperformance in mid-caps and small caps. While rally has become broad-based recently, there is still considerable divergence in valuations across sectors compared to their long-term averages. Second wave and equity markets. The resurgence in COVID cases over the past quarter has had minimal impact on equity market performance. Interestingly, Nifty 50 has risen by approximately 7% since end March 2021, despite strict lockdowns imposed by most states. This is probably because of multiple reasons. Firstly, the impact of manufacturing and goods mobility was relatively lower compared to first wave, as the lockdowns were more localized. Further, Firms were better geared to adapt to COVID protocols during the second wave. More importantly, bearing of lockdowns on corporate earnings is likely to be limited, and that too transitory, on bulk of sectors in Nifty 50. This is also reflected in the broad-based earnings revisions and upgrades in Nifty 50 earnings since the downgrades seen post-lockdown in Q1 FY21. Specifically, impact on FMCG, pharma, telecom, utilities, IT, etc. is likely to be limited. Further, global cyclical sectors like metals, oil and gas, etc. are not materially impacted due to local conditions. Additionally, large players in financial services stand to gain from lower provisioning costs, competitive technology leading to cost savings, and possible increase in market share. While sectors like auto and other discretionary spends might get impacted, but their weights in Nifty 50 are relatively low. Interestingly, global experiences of equities in US, UK, Eurozone, etc. during the second and third wave was also similar, and impact on equities was limited. Outlook. As on 30th June 2021, Nifty 50 was trading near 19.3x FY23E price to earnings ratio. In our view, these are reasonable multiples, especially given the low interest rate environment and healthy earnings growth. Further, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield stood at 1.4, below its 10-year average of 1.7. Further, though Nifty 50 is trading near all-time highs, if one views the 10-year CAGR of Nifty 50, returns are largely similar to growth in India's nominal GDP. In view of the above, in our opinion, markets hold promise over the medium to long term, and there is still good value in select pockets of the market. Improvement in corporate profitability, fall in COVID-19 cases and relaxations in restrictions, easy financial conditions and low cost of capital, comfortable external sector, supportive monetary and fiscal measures, etc. also bode well for equities. Thus, there is merit in increasing allocation to equities in a phased manner, or in staying invested with a medium to long-term view and in line with individual risk appetite. Resurgence of spread of COVID-19, premature unwinding of fiscal and monetary stimulus, higher than expected NPAs, etc. are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.